Good morning and welcome this morning to Trading with Technical Indicators, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Rachel Deschelle, and I would say 20-plus year veteran of the financial markets, but that would mean that she started when she was 8 years old. But I'll tell you what, Rachel is a great friend and a great educator as well, so I'm glad to have her out there in the chat to help facilitate the conversation. Let her know by keeping that chat going. Ask her some questions along the way. If you're watching this in the recorded version, by all means, leave us a comment and make those comments in the comment section. We'll get back to those as quickly as we can. And as, of course, you know, I am not James Boyd. So today is going to be a little bit outside the normal discussion thought or chain of this particular webcast. However, I hope that you will find that it is something that is useful to you, because this is based on one of the questions that I get oftentimes when I'm teaching live, for sure, and in the virtual environment as well. And so it is one of those things about technical analysis and technical indicators that human beings often ask, and it's kind of a focus on optimization. What is the best? And I always answer, well, don't I deserve the best, in my best Gaston voice from Beauty and the Beast? The really true answer to this is there is no one best technical indicator. So we're going to talk about that. We're going to talk about how we might go about finding what might be best for a particular security or for a particular time frame or a particular market environment, or when we say best, what might be better for a particular time. So we'll go through that process, kind of an iteration process today. A couple of quick housekeeping items, though, as we get started here. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation. It is not any kind of advice or endorsement. If we do talk about options, remember that options carry high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, remember that when we talk about technical analysis, which we will in today's class, since it's kind of in the name, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version. Now, I want to point this out really quickly, because some people have said, well, I didn't know it didn't do that. So I want to make sure that you hear this, and I say this, properly warned you be, says I. Again, going back to Disney, you're right, Josh. Everything comes back to that. When we use the Thinkorswim desktop software platform, there are certain things that the paper money version does not do. One of those is it does not facilitate the early assignment of short options. Two, it does not allow for the use of studies, either scripted or pre-built studies, in scan tools. So just be aware of that. That is a known issue, and it is on purpose. It is a feature, not a bug. Remember that past performance, not a guarantee of future results or success. And since we're going to be doing a little bit of backtesting, recognize that backtesting is not A, a guarantee of future success, B, guaranteed as to time or accuracy. So we'll talk through that process as well. And of course, remember that investing involves risk, including the loss of principal. So let's jump over here to the Thinkorswim desktop software platform. Let's take a look at a typical type of approach. And I know that James has his own way of evaluating the market, his own way of looking at using technical indicators, and in fact, his own analysis based on a specific set of technical indicators. A, that doesn't mean it's the best. B, it doesn't mean it's the best for everybody. And C, it doesn't mean that if you were to absolutely replicate the same set of circumstances that James was looking at, that you would be able to achieve the same results. That's just the reality of the situation. Now, we're taking a look here at GE over the course of a 1-year time frame, and I've drawn in some levels of support and resistance here. For those of you who have been in one of my webcasts, or you've been in one of the live events that I teach. And by the way, the next time we're going to be live, we're going to be in Anaheim coming up this Saturday doing a market drive event. And then we're going to be in Houston. I think Rachel's going to be at the Houston event. We're going to be in Houston the beginning of December, and then we're going to be in Miami. I know Rachel's going to be in Miami towards the middle end of December at those live events. But when I talk about technical analysis, one of the things I talk about is the idea that trend is really kind of the genesis, the basis of what we're talking about. And two, I talk about the idea of not being too particular and not too precise in that technical analysis, because it is based on looking back at past performance and then making a projection, not a forecast, not a prediction, but a projection of what might happen given a certain set of circumstances, that it is by nature imprecise. You can't calculate technical analysis levels to the penny and then expect that to project into the future. So we got to take it from a little bit more laid back approach, from that not too particular, not too precise approach. And so that's going to be the kind of the hallmark of this discussion along the way. So taking a look at GE, and you're right, it is a trending chart moving in a particular direction. And for those of you that have been in the one of the live events, one of the things that we talk about is defining trend direction based on just a moving average. And so this is what at times I will often do is I'll just come up here to the flask icon up at the top of the page, and I'll put on here a moving average. And in this particular case, I'm going to put on a simple moving average. And I'm going to put on a simple moving average of a 50 period length. I'm just going to make it a little bit thicker so that we can see it a little bit better. It's going to be no displacement, no mathematical manipulations. It's just simply calculate the number of days that we're looking back, add up those closing prices, divide it by the number of days. That gives us our simple moving average plot. It doesn't mean it's better or worse than anything else. It just means that it is not enhanced or optimized for any particular mathematical optimization, whether that's weighting new data more heavily or anything else. It is simple and straightforward and a fairly straight plot. So 50 period moving average, no displacement, nothing else going on here. Just 3 pixels width, that kind of bluish green color. We're going to click on OK. And I'm going to turn on my eyeball here so that we can see that on the chart. And the first thing I'm going to do is I'm going to define this, click on apply and OK. And this is my intermediate term moving average. Now, let's talk, because I tell you, we today in this webcast are very lucky in having Rachel in the chat, because Rachel is a certified chartered technical analyst. That means she's studied, she's done the work, she's got the letters behind her name to be able to be a genuine, dyed-in-the-wool technical analyst. Okay? So if we've got questions about technical analysis, she is a perfect companion to this webcast to ask those questions of. But one of the things that we do is we define the time frames in which we are looking at various approaches. So this time frame, using the 50 period moving average, the way that I would define it would be an intermediate time frame, so weeks to months, and 50 periods, in this case days, because it's a daily chart. This is a 1-year daily chart. That 50 period time frame kind of covers that weeks to months time frame. Now, we could define it slower, we could define it faster, but many, not all, I'm not going to say most, I'm not going to say all, because I don't know most, and I don't know all technical analysts or investors or traders, but many will use a 50 period moving average as a definition of an intermediate time frame. Now, the real Enrico asks the question, is there an industry standard for color coding for moving averages? No. But that's an interesting question. Here's what I like to do, because I'll show you this. I'm going to go back to that flask icon, and I'm going to put on one other moving average here. It's another simple moving average, and I'm just going to turn on the eyeball, and that's a 200 period moving average, simple, straightforward moving average. And I've got kind of this nice pink, purple, calming moving average on there, that 200 period moving average. So the reason I say it's pink, purple, calming, that 200 period moving average is what I would define as a longer term or a long-term moving average. So giving me a definition of the intermediate term trend on that green, the purple, the longer term moving average, and we could add a third on here. And that third might be, a 10 or a 20 or a 5. I know James likes to use that 5-day or the 10-day moving average. And oftentimes in terms of color coding it, I'm going to make that one red or orange or something that's bright and emergent, that's going to tell me that's the one that needs to have the most attention paid to it because it is the most, it has the highest priority, just simply from a time frame. So that's how you might go about color coding. There is no industry standard in terms of doing that. So I would argue to Beth's question, which I think is a great question. Beth says, well, if we could cover the variables that might increase the probability of a successful trade, first and foremost might be trading in the direction of the prevailing trend, regardless of what that prevailing trend might be. So as we start to look at other things, we might add into the mix other types of characteristics to help us to confirm what's going on. But, we can make the argument at the moment that the trend here, intermediate term, long-term trends are both still up, moving in an upward direction, not changing direction yet, nor is this making really lower lows yet. So once again, not breaking down. So we could put a more rapid moving average on this. Let's just do that for fun, because I want to kind of go through this process. And again, we're going to be iterative about this process. So I'm just going to go over here to the chart, SIMP, simple moving average is what I'm going to start with. And we're going to put another simple moving average on here. I'm going to make this a 10-day moving average or a 10 period. You're going to hear me use those interchangeably because I'm normally by default on a 1-year daily chart. But it more correctly is a period. So this is a 10 period moving average. I'm going to make this 3 points wide. And as I said before, I'm going to make that kind of that emergent red color. And you're right. And Enrico, so if you get the same colors, and you'll see that I use the same ones most often, click on OK, apply, and OK. And there's my red moving average. Oh, by the way, speaking of emergent, there is an emergent feedback survey out there in the chat. Rachel will repost that a couple of times for you so that you can grab it. If you want to right now, just grab that URL, click on it, and set the that window aside, and then you can come back to it at your own leisure to set that up. So the other thing I happen to notice here is we go to those 3 different moving averages. Short term, in this case, 10 days. Now, if we define short term as days to weeks, a 10 period moving average or a 10-day moving average incorporates really that kind of time frame, 2 weeks of 5-day trading weeks. So that gets that days to weeks kind of time frame. And what I can see is that the only one of these 3 moving averages that is moving down is that 10 period moving average. That is giving me an indication that in the short term, I could objectively say short-term moving average is moving down. This isn't a short-term downtrend. It doesn't mean that it's collapsing. It does not mean by any means that the short-term move to the downside is going to take out or make the 50 period moving average, that intermediate time frame, turn down, or especially the 200. It's got a long ways to go before it gets to that point. Now, I get it. There are other reasons that we might use for confirmation, but I've got a short-term downtrend here. Lower highs and lower lows in the short term, and I can draw that in objectively, right? That is a short-term downtrend, no question about that. But intermediate term time frame, this is still making, if we go to weeks to months, still making higher lows. Still making higher lows. And again, objectively, I can draw that line in here and I can say, what's the angle of that line? It's still making higher lows. Again, I'm gonna keep pounding this until people understand what that higher low means. The higher low means that it has not yet broken a level of support in that intermediate term time frame. So until it does that, again, and I'm going to reiterate what I said on Friday. For some of you were with me on Friday afternoon when we did the market and sector analysis webcast, focus on what you see, not what you fear or hope or hear in social media or anything else, right? So, not saying it's bullish at the moment. I'm saying that the intermediate term trend is still moving higher, long-term trend still moving higher, right? So when we start to look at those levels, that's exactly what those moving averages tell us. So let's talk about lag and let's talk about displacement, because I know Rachel helped to answer that question here. One of the things that we think about in terms of using moving averages is that when we have a moving average of a particular time length, it tends to lag behind price movement by about half of its period, okay? By about half of its period. And its period in this particular case, so if we were to think about this, the 10-period moving average is going to lag by about 5 periods, about 5 days. And you can start to see, if we go back 1, 2, 3, 4, 5, that's about the time that we started to get those lower lows and the time that the 10-period moving average started to pull back a little bit. If we go back 50 days, so there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10, 20, 30. So about 25 is where this is kind of leading from, where that 50-period moving average is leading from. It's kind of reflecting what's going on right here. So yes, it is lagging, but even if we go back and look at where that lag is reflecting price movement, it's still moving higher, and we have not yet had a lower low since that point. So at worst, sideways; at best, still bullish and into some consolidation in this particular case. Now, again, I'm going to keep kind of repeating this. If trend is the kind of basis or the genesis for our thought process, number one. Number two, might be using some other form of technical analysis as a means to confirm. And the problem is, though, when we start to use other forms of confirmation, that becomes a little bit of a perspective of belt and suspenders, right? Because as investors, we tend to start thinking about, well, if that one indicator is good to give me confirmation, then 2 or 3 or 4 indicators might be even better. Because if I'm going to put a belt on, I'm going to put suspenders on, I'm going to tie a rope around my waist the same way, so I get those same types of things, right? I get the same type of confirmation. Some indicators, we've talked about this, and I'm not going to go into that particular discussion necessarily too far, although I have, but some indicators work better in conjunction with others. So here's what I wanted to look at. We've got the RSI. This is the relative strength index down here in the lower panel. And I'm going to draw a line across that RSI here. And again, not too particular, not too precise. I'm not worried to the penny. And I've got a bit of a downward move. I've got lower highs in the RSI. I've got roughly equal over that same time frame, roughly equal highs in the price action over that same time frame. So this is a little bit of a bearish divergence. And by the way, Rachel has done some extensive stuff out there on X. If you follow Rachel on X, at Rachel-CS, right, Rachel? You put your link out there. I think that's what it is. I'm at Ben Watson CS, but I know Rachel has talked a lot about divergences, and she posts a lot about divergences. So here's the thing to think about. If GE is giving us a short-term pullback with the RSI making equal lows, that's not a bearish breakdown. That's a consolidation. That's an indication that momentum has slowed down into this consolidation period. Doesn't mean until we get evidence, objective evidence of lower lows and breaking support levels, doesn't mean that this is breaking to the downside. There's also the other thing to think about is that the stocks and the market generally have an inherent bullish bias, right? An inherent bullish bias. That inherent bullish bias is companies are in business to make money, period, end of story. If there are notable exceptions to that, and when we say make money, that is kind of a fundamental definition. But companies are in business to grow their share price, to appreciate that price of the stock. And so they want to go higher in this case. So, you know what? I'm done arguing this, because this is something that as a technical analyst, and Rachel's going to bear me out on this. This is a consolidation pattern. Price is moving sideways. It is not making new lower lows, and it is simply consolidating here. I'm more worried if I see something like this happening where I get a bullish divergence where the RSI is moving higher and price is still moving lower. That's a bigger deal to me than price moving sideways and the RSI rolling off a little bit. Despite whether or not you are a perma bear, doesn't matter. Evidence is clear here in terms of what this is doing. Not that it's going to guarantee, because this can change at any particular moment. But the fact is, it's still moving in a bullish direction. All right, so now we've kind of got this thought process in terms of the probability of what leads to maybe a successful trade. Trading in the direction of trend, trading with confirmation from other indicators. So now the question becomes, how do we decide what is best? So I want to get to really the heart of this discussion. And now we're going to kind of go back to these moving averages. And the thought is this. We can use 3 or 4 different moving averages. I like to use that 50 period or that 200 period moving averages, kind of that overall trend direction, to say, yeah, this is up or this is down. And then how do we go about using this for entry and exit signals? So some traders will simply do this. They will use those crossover points or bounce points of a slower moving average versus a faster moving average. Yeah, so InfoNerd says, are these levels of support and resistance that I've drawn in with those yellow? Yeah, generally, or they're points where I've used to indicate something. So resistance up here, support along here. You've got a couple of different levels of support along this way right here. So here's the thing. Some traders will use these crossovers as entry and exit signals. And that's what we're going to go back to in terms of, so Chuck says, well, why not use a hull? Why not use the whole moving average? Here's what I'm going to say about this. There is no one best technical indicator, and maybe whole move works better in some circumstances than others, but it is not a silver bullet, number one. Number two, it is not a panacea for all stocks. And if that were the case, then guess what happens if there were one best technical indicator? The market's going to grind to a halt, because then everybody is making the same decision based on the same indicator, and there is no more difference of opinion. So let's try this and let's bear this out. So what I'm going to get to here is this idea that we're going to use crossovers as an indication of entry and exit. Yeah, you say that, Josh, and you don't want to get me on the soapbox here for this, because because you've heard me do this before. What happens to us as traders is like what happens to us as human beings for anything. We want the best. We want to optimize. And then we spend so much time optimizing that we spend no time using. So let's do this. I'm going to say this. We're going to use a crossover system, and we're going to evaluate a crossover system straight. We're going to take it from simple moving averages all the way to whole moving averages, and we're going to evaluate it from the standpoint of what is better for a particular instrument. So in this particular case, the instrument we're going to use is GE. I'm going to use a 1-year time frame. We may expand this time frame out a little bit. So the crossover that I'm going to use in this particular case, and I'll even go back to the 10 and 20, right? That 10 and 20. So what we're going to do is I'm going to come up here to my Flask icon, and I'm going to hide the 50. I'm going to hide the 200. I'm going to hide that 10. And what I'm going to do is I'm going to go to the strategies sub tab here in edit studies and strategies. Now, this is very important, so pay attention. We've done a couple of webcasts on this about using strategies as a means to backtest. Strategies as a means to backtest allow us to create simulated entry and exit points on a chart so that they can be evaluated over time. Backtesting is not a guarantee of future results. Number one. Number two, it is not guaranteed as to time or accuracy. So your mileage may vary. But the strategy that I used, and I've created a number of them here. I've even got a couple of different webcasts where I've talked about how you turn a study set into a strategy. But the one that I'm using here is this moving average 2 lines strategy, and it's right here. If we come down to moving average 2 lines strategy. And it is simply looking at the crossover between one moving average and another moving average. So and that's not loading for me. But what it's simply looking at is entering long when the shorter term moving average crosses from below to above the longer term moving average, and entering an exit. Now I'm just going long here. I'm not going short. You can set it up to go long and short to trade both directions, but we're just going long here in simulating what many investors do. So we're going to change this to a 10 and 20 simple moving average to begin with, and we're going to evaluate those entry signals. So I'm going to go over here to the gear icon for my moving average 2 lines strategy. I'm going to turn on the eyeball so that it can be seen on the chart. And I'm going to go to the gear icon. And I'm going to make the faster moving average a 10-period moving average. I'm going to make the slower moving average a 20-period moving average. Okay? So we are just, in this particular case, going to use a long entry and exit approach. We could turn on short entry and exit, but here's what we're going to do. I'm going to disable that. So we're only looking at trading bullishly, only looking at trading long. And we're going to make this create that position. So when we go long, it's going to initiate a simulated trade. And when it gives us an exit signal, when that crossover happens again, it's going to exit that long position. It's not going to initiate a flattening and then going short. So we're simply going to be going long. And I'm going to click on OK and apply and OK. So what you're going to see here on this chart is those entries are going to come on that crossover of the short-term moving average versus the longer moving average, the longer-term moving average. So here it is right here. Click on apply. Whoops, I want to go to my gear icon and make sure that we are doing that, and that is enabled. All right, yeah, I think maybe we need to turn both on just to see it. Click on OK and apply and OK, there we go. Okay, so that's giving us our exits here. All right, so let's just kind of look at one of these points that we're seeing on the chart. I'm just going to zoom in right here in the middle of the chart. So here is our long entry into the trade, right? We get into the trade here when the short term crosses above the longer term. And then we scroll forward. This one we're in for a fair length of time. And then we get out when that moving average crosses over right here. So there's the crossover, there's the exit. Here's the entry, and there's the exit. Here's the entry, and there's the exit. So we just got an exit signal. And you're right. And then you get, so Kelly, I know you've done this before. I know we've had, I think, this conversation before. So all I'm going to do is now, given this is a 10-period and a 20-period simple moving average, long trades only, I'm going to right click and I'm going to come down to here to where it says show report. Thank you, Rachel, for popping that in there. So I'm going to click on show report. I'm going to make this a little bit bigger so that we can see it, although I'm not going to make it as wide as it is. Okay, so what this is going to take is the time frame indicated on the chart. This is 12/9/24 through today, 11/17/25, and going back all the way to that time. Okay, so we're going to scroll down through this list, and we're going to see the total number of trades, 25. We're going to see that was in and out, the total profit and loss, 3,160. And the total number of orders was 12. And it's going to tell you when you got in, when you got out. And again, not guaranteed as to time or accuracy, simply a projection of what that strategy is showing, right? And you're absolutely right. You can show profit and loss as a cumulative indicator. I don't want to mix this up at the moment. I will put that on here in just a second, but I wanted to show this here in terms of the comparison. So 3160 was our total profit and loss for this 1 year time frame, taking those trades. Unfortunately, Josh Pink, not yet. Yes, and you're right. There are some limitations to this. You're right. So Ted points out fills are coming on the next morning. Gaps may distort because this is using closing prices. So we're going to click on close. So we know that this is 3160. So let's come over here. Let's open up our scratch pad. Let's scroll down in our scratch pad. I'm going to add this. So this is 10/20 SMA over this time frame, 3,160. Okay. Now we're going to close that. And we're going to come back over here and we're going to edit this again. A couple of different ways you can do that. You can right click on it and edit it that way. But I'm going to go to the gear icon and we're going to say, all right, we're going to leave this 10 and 20. We're now going to make this a 10 and 20 exponential moving average. Now, not yet, Ocean Life. Is there a way to scan all the reports to see which strategy is most profitable for a specific stock? It is getting to that point. It is getting to that point. Now, Chuck, you could absolutely put this on the chart. There is no difference between just putting this on the chart. Here's what I'm going to say, and a lot of people will ask me this question: what impact is AI going to have on trading? And I think probably the realistic best case or best use case for AI will be at some point sorting through different strategies, different inputs, and finding that optimization. It's not there yet, and it's getting there. So we're going to click on exponential, make this exponential. We're going to put that on the chart. You can see that there, apply, and okay. And now we're going to come back to the chart. And we're going to say, all right, where were those entries and exits? And we're seeing that they're concentrated back here at those whipsaws. So I'm going to come in and I'm going to right click and we're going to show report. And we're going to make that report a little bit wider so that we can see it. We're going to scroll down, and an exponential moving average in this particular case, same characteristics. This is a 10/20 EMA, nets us a minus 5,600. For that same time frame, same perspective, nothing else has changed other than simple moving average versus exponential moving average. Why? Exponential moving averages, because they give us this faster signal, oftentimes create false entries during whipsawed time frames because it weights that recent data more heavily. So that's an exponential. All right. So let's try the next iteration of combination here. We'll go to the flask icon up at the top. We're going to change this gear icon. We're going to change that from exponential to weighted. Now, a weighted moving average is going to show you, if we click on weighted and we pop over here to the learning tab, let's go ahead and close that back down. Oops. We'll click on OK and apply and OK. We're going to stay here on the weighted moving average that shows the average value over a period of time, heavier weighting to most recent. It's very similar. Weighted is a very similar moving average to an exponential moving average. It's just a different mathematical calculation. So now let's go back to our chart and see, wow, a lot more trades here with a weighted moving average. We're going to right click, show report. We're going to see that we had, in this particular case, 29 trades, 14 entries, and a weighted moving average as opposed to an exponential. And again, mathematical difference aside, 20, 10, and 20 weighted is a positive 3,722. Okay, so a little bit better than just a simple moving average, much better than an exponential moving average. All right, so we're going to close this one down. We're going to look at that Flask icon. We're going to go to the gear icon. You know the drill by now. Now we're going to go to a Wilder's moving average, which again is going to be a different mathematical calculation. We're going to click on OK and apply and OK. This is a little bit more smooth, a little bit more similar to the exponential. So we're going to say 10, 20, Wilder, as in Wells Wilder, the godfather of technical analysis. And we're going to right click and we're going to show the report. Make that a little bit wider so that we can see it. Wow, not so much there. 4 trades in and out. And again, it doesn't get us in, it doesn't take us out. So at that particular point, we are long still at the moment. So that one hasn't closed out yet. So again, that is one of the challenges here, is that you have an open position not calculating, but it is calculating based on possible gain, assuming that time frame. So we're going to say this one is minus 8,774. So that's the worst of the bunch so far. Now we're at 10 period, 20 period Hull. Now we could use others, and we can script this to use others because there are triangular, there are displaced. We've not changed any of those other characteristics in this particular moving average. We're just using what's box stock out of the box here. Now we're going to go to the Hull moving average. Now this is the one that I know that many of you are waiting to see because you've asked me here. So this is the Hull moving average. And again, Hull moving averages are displaced moving averages that are mathematically adjusted to eliminate, to use a James Boydism, eliminate that lag from that moving average. But they also are subject potentially to whipsaws. So we're going to click on OK and apply and OK. Wham! Boom, 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 boom. We're getting kicked in and out, right? Kicked in and out quite a bit. So let's just do this. Right click, show the report. Let's see how many trades we are in and out. 30 total orders, 61 trades, and the Hull moving average gives us a net gain over the same time frame, same characteristics of the moving averages in terms of the periods of $238. So again, I kept as many things equal. I didn't change anything else. I kept as many things equal as possible. In multivariate analysis, you got to change one variable at a time, right? So in this particular case, not changing anything else, the Hull moving average was the third best in this time frame on this particular security. I'm going to reiterate it again. That doesn't mean that it is the best, the worst, or anything else. It just simply suggests that in this time frame on this particular stock, that combination of 10 and 20 is not giving the same signals or results that a 10-20 simple or a 10-20 weighted would give. Here's the other thing to think about. Is you've now got more than double the number of trades here. So if you've got transaction costs for each one of those positions that you're taking, entry and exit, if you've got a transaction cost. And again, I'm not getting into transaction costs. Those are not the purview of this. But if you've got transaction costs, you've got double the number of transaction costs eating away at that. So given that discussion, now we can iterate. And again, our time frame is such that we can't do all of the iterations perhaps that we would like to. Let's just try one other stock. Just really quickly, now that you know the process, let's go through another stock and let's see how this changes. Okay. So I noticed that, let's see, somebody had asked me, let's see. Somebody had given me another one up here. Let's just take another one down on this list that's breaking out. And so what I'm going to do is I'm going to come back up here. We're going to change this. Let's close this down. Let's go to, I think, another breakout. OKL. Oh, Oklo. No, that's not breaking out. What was the one that was breaking out today that I was just looking at a minute ago? Let's just take this one, TSLA. We'll just go with that one. All right, because that's giving us a little bit of a bounce here, a little bit of a hold. So let's just take Tesla because it's got some variety to it. And just do the same thing. We're going to come back to the flask icon. I'm going to go back to my gear icon. We're going to roll this back to simple. Now this is Tesla. We're going to click on OK, apply and OK, and right click. Whoops, right click on the chart. Let's find it. There it goes. Right click on the chart, show the report. This is Tesla. We'll scroll down. 29 trades. So this is Tesla. That was GE. This is Tesla. 36. So this is SMA. 3,641. Are you still there? I'm still here. Are you guys still there? Okay. All right. So let's do this. So there's SMA. Let's go back and let's change that to weighted. We'll go to exponential too. Click on OK, apply and OK. Exponential, show the report. We'll scroll down. We'll do this more quickly. Exponential is minus 5,668, same time frame. And I'm just going to, for the sake of streamlining this, I'm going to go to the Hull moving average. We're going to click right there. You can do the next iterations yourself. I'm going to go to the Hull, still 10, still 20. We'll click on OK, apply and OK. Right click, show report, scroll down. And by the way, you can export these reports if you want to keep them in a spreadsheet. And this is 27 trades, just about the same, well, actually about double still the number of trades. And we're at positive 10 or 1,023. So SMA, exponential, or SMA, Hull, exponential in order here. So again, this is an iterative process. You can export these files, like I said, you can put them in, and then you can use whatever kind of AI tools that you want to on those Excel files or spreadsheet files to do that analysis. But this is a process that traders can use when evaluating technical indicators. And if you want to build a strategy set here in the strategies that are available, you can build a study set here, or you can build a strategy set. So let me just come down to this one real quick, and I'm just going to show you how you would do that really quickly. I'm going to point you also to resources. Click on the little scroll here to the left-hand side. Now you've got the study, the ThinkScript for this particular study. The key to making this a strategy, besides saving it as a strategy, is having these words, add order, in the mix. So add order and add order. That's what's going to make it a strategy so that you can use this on the chart to generate those back testing reports so that you can then make an evaluation. Now, I'm going to be cautious here. And as we pop over here to the webcast page, I'm just going to say this. Back testing can be a rabbit hole that will take you forever. Strategies. There we go. Let me do this. Strategy. Think script. Okay. I think I did it a while back. I'm not sure when I built it. There it is. Strategies and backtesting. This one right here. And I'm going to do this. I'm going to get the code for that. And I'm going to paste it in here into the chat. Remember that anytime we share anything, it is for illustrative and educational purposes only. It is not guaranteed for time or accuracy. When you backtest something, when you do this, this is something that you can get lost in. So use it with caution. But do me a favor, give us a like here on the webcast today. Also click on subscribe and give us a follow there as well. My thanks to Rachel for helping out. My thanks to all of you for being here with us. Boy, our time went fast. Thanks, guys. Have a great day, and we'll see you again very soon. Take care, everybody. Bye-bye.